Events. Today, we're talking about one of our favorite topics. We've discussed it before, but today we're going through a little bit of some tips and tricks. And that is, of course, how do we use supply and demand theory to potentially scalp, day trade, and even swing the markets? My name's Thomas Atkinson. As always, I'm joined by Tyron Abella. How are you going this week, Tyron? It's going to be a
Good.
mega week, isn't it? This is huge.
It's a mega week. Look, this time of year, earnings is rampant. We've got news everywhere. Look, it's going to be a big week. And look, and this is why we love coming to you, on Wednesdays, really, Tom, because, Wednesday's the center of the week. We get to see a bit of market action at the start. All the big actions generally heavily weighted to the end of the week as well. So we get to have a look at what the market's doing and setting up. So I know we've got some exciting things coming from Pepperstone in the next 2 weeks. So keep an eye on your emails because we are going to be bringing you these webinars thick and fast, but it's going to have a twist. It's going to be very, very interesting. So certainly keep an eye on your emails because there is going to be a change in the content from next week.
I'm excited for that change too, Ty, because I think it'll really add a lot of benefit for people to come every single Wednesday. As Tyron mentioned, it's the kind of like almost the biggest news weekday, but it all starts like, you've got your Tuesday and your Wednesday. We used to get asked a lot of times, what's the best day to start trading? And it's arguably Tuesday or Wednesday, sometimes even Wednesday being the better one for trends, specifically if you're getting into swing and day trading, Ty. I think it's one of the best entry areas.
Yep, I think we're allowed to say. I think we're going to start doing live analysis, Tom. I think that's the rumor is that we're going to start doing live analysis. We've been doing this for a very, very long time, and we used to do live analysis all the time for Pepperstone, and then we went to a topic-based system. But it appears that we're going to that model to bring you every week what's happening in the markets with the different ideas and methodologies that we talk about all the time. So we are really, really excited about that. So hopefully you'll be excited about it too. But look out for your emails because it will all be there.
All right. Well, without further ado, Ty, we're about to get into some theory. And then, of course, we will be going through some live market analysis today to kind of back up some of that theory. So let's go through a quick risk disclaimer. We'll see you in just a moment. Okay. So, Ty, learning to trade with Pepperstone, strategic scalping, harnessing the supply and demand dynamics for better entries. This is what we'll be talking about today. And of course, we'll be talking about zone identification. How do we talk about order flow analysis? I believe the future in trading is going to be position-based analysis, which supply and demand is heavily based on. And obviously, how do we use price action to potentially confirm these entry points, whether it be, a big change around the supply and demand level, or whether it be something that we recognize as a position. And of course, there's always Q&A. So if you have questions, feel free to ask them throughout today's session and we'll answer them as we go. So straight away, Ty, I guess you know what's coming, and it's my favorite. We've got the Wyckoff counter number 1 for this week. And it's the same quote I always go with because, of course, it's pretty much the beginning of supply and demand. And that is that successful tape reading is the study of force. It requires our ability to judge which side has the greatest pulling power, and one must have the courage to go with that side. Now, I did promise that we'll bring in some more quotes, and we'll have a few here today that we'll be talking about. But specifically, look, you've all heard many of the quotes out there, the famous ones. We've got the Warren Buffett, quote about, obviously, rule number 1, don't lose money. Rule number 2, don't lose money, Ty. That's literally what it is. But, what you actually understand is as you go through your trading and investment journey, these quotes mean different things. They may not mean much when you first begin, but then as you actually start to learn some of the harsh lessons, you find that you come back and you gain a deeper understanding. And I find that to be true with almost any of the great investment quotes out there.
Yeah, most definitely. And they do. What you take from it is really, it's the message that you take that's going to resonate with you. And sometimes people can really construct different things out of different sayings. But I think for the most part, the Wyckoff one, you've mentioned it about 150 times in the last year, Tom.
Yep.
And I'm pretty sure we know your opinion on it. And it's a very, very important one because it really is the basis of what we're talking about today.
Yeah, so it is the basis because really when we're talking about anything to do with supply and demand, we have to study force. We have to study who is in power and who's going to be the winner. So we've used this chart a few times, and it wouldn't matter whether it's Australian US dollar, whether it's a stock, whether it's an index or anything like that. What it's talking about is that when markets come down, I'll give you a tip number 1 today, Ty, is that when markets either come out of a strong upward trend or a strong downward trend, they do tend to stop, and takes a while to change the trend, doesn't it? It's like stopping a freight train. Can you stop a train with one truck? It'd probably go through the truck. You'd probably need 10 trucks to really stop it, or a brick wall. I don't know. Maybe you need a few brick walls. And that's because the trend is so ingrained. It's so powerful. So to stop it, you're going to need somebody to come in and make a big decisional change, a big player. And of course, us as retail traders, we can't move the markets like a big player can, or as Wyckoff called them, the composite man, effectively the entire entity of the market making a change of decision. And what it is for us as investors and traders is to make a decision based on being able to recognize when somebody has changed trend, when someone's effectively said, you know what, no more shorting. Now we're going long and we've built a position in here. And that's really what supply and demand is all about. And in essence, it's probably where I want to stop today on that, actually, because what we tend to find is we've done so many of these live sessions, Ty. You can go back through the catalog on the Pepperstone channels, so make sure to watch those and you'll see all of our basic theory. What I want to get to is the idea that when a market comes down, it is purchased by somebody and you'll see it kind of manipulated throughout price like this. And oftentimes what price will do is it will actually make a lower low in the terms of accumulation. And during that lower low, it will take out people's stop losses that are on the buy. Now, remember, if you have a buy, Ty, to get rid of a buy, you have to sell it back into the market, don't you? So that means 100%. That if I was looking for a position and let's say looking for liquidity, if I was forcing you to sell it back into the market, that would therefore allow me to buy more. So that might make me quite smiley face when it comes to purchasing my trillions of dollars, or in this case, probably billions of dollars of positions throughout. So just remember that what you're going to need to be doing over the next couple of years, specifically if you want to use supply and demand in a different kind of way, is recognizing these traps, these tricks that the market tends to put through. Because you'll find that being reactionary to those traps will actually, we often say patience, react, don't predict. Let's call it that, our quote, Ty. And that's because although prediction is great, and sometimes you'll get it right, generally speaking, your odds are better when you start to recognize where people have been liquidated. And unfortunately, that's trading. Someone wins, someone loses. And that is actually how it is, isn't it? When you think about it, for someone, generally speaking, someone is winning and someone is losing, aren't they?
It is. And I guess, look, a lot of people say, well, can't everybody win? Well, no, not everybody can win. And you really shouldn't be worried about the people who are losing, because that's why you're putting yourself in a position where you can take advantage of that. I mean, someone's going to take advantage of it, so it might as well be you. If you're not taking advantage of those weak positions, the big liquidity grabbers are going to. So you might as well be in the, and going back to the quote, really, you need to decide and understand where the force is going and work with that force. There's no prizes for being, against a very, very strong trend and maybe taking little snippets out of the market. You want to be with the bigger trend. It's really, really important to understand where the real big money is, because you want to be trading in that direction. And when you understand the market dynamics and you are trading in that direction, it's like you're playing with the big boys, aren't you, Tom? Like you're not really, you know, when you were kids, if you were in grade 3 or grade 4, and sometimes you had the opportunity to play with the grade 6s, whatever they were doing, whether it was cricket or footy, you always felt better about yourself, because you know what, the better kids or the bigger kids made you better at whatever you did. It's the same in the market. Mm-hmm. When you learn to trade with the bigger players in the market, you're going to become a better trader, because you'll be better understanding where those situations are located and how to take advantage of them faster.
Yeah, and I think it's always there's always a bunch of different kind of concepts you can use for trading, Ty. And I was just thinking of a quote. I said I'd bring quotes in today. So here's one, and this has got to do with losing. The market is a device for transferring money from the impatient to the patient. And of course, that's a famous Buffett quote. And it really just means that, again, when we're talking about reactionary plays as well, if we are patient enough to wait for the right positioning, then we do tend to do better. There's a whole bunch of these ones, though, and they all make a lot of sense. All right, well, let's jump into some charts here, Ty, and start talking about the basics of supply and demand and, of course, the more advanced thought process. And there's been some great levels here on the euro US dollar over the last kind of week. And it's a pretty classic one with the break of structure and, a pretty good setup. And a lot of people will have misseen where the supply is. So I guess we'll talk about this today and why it's so important. So the market obviously has come down, and you can see it's built a position. Something's going on here. And then eventually it's broken to the downside, making a new lower low. Now, this is significant because, of course, it's broken through what has arguably been 1, 2, and 3 times found as support, and buyers have obviously pressured it back up. Now, when it breaches that level, as a supply demand trader, you're actually interested in if it ever comes back to that level in the future. Now, there are multiple different theories here. There's obviously the one where, if you think about it, this could become what they call a support becomes resistance kind of area, but it's actually also a supply demand. You'll notice in trading, there are a lot of synergies between these types of things. There are synergies between support resistance trading, supply demand trading, Elliott wave trading, Garn trading, any of these types of things. They all kind of come together, and sometimes you'll have a lot of them stacking on top of each other. And when you can build confluence of a zone, especially if you recognize where the orders are, then it can be really, really powerful. Now, I mentioned orders because the difference between a support and resistance trader and a supply and demand trader is a supply and demand trader specifically looking at where they believe a reaction is going to be made based on previous large orders being placed. And the traditional one would be, let's get rid of this yellow line here. Have a look at this chart. The traditional one would be instantly people would say, well, this is where the supply is. And I don't think they'd be wrong. The reason why you would say supply is here is because it was an area where a position was built that led on to a large fall that broke through a big structural area. This is what we often call a break of structure. Now, this type of area is very important because it means, Ty, that something huge has happened. And traditionally, whenever we break a structural level, being a lower low, like one that's on a big time frame like this, like a 2-hour or a daily, or on a weekly or any of those things, usually that happens through a massive change in pricing. And that's usually news, isn't it?
Yeah, that's
we're seeing
right.
this week.
Yep. Yeah, absolutely.
Yeah. Now, why it's so important is because if we see it happening all the time and it's happening in the fate of news, so we're seeing it happening around news, is that means that large positions are coming in to price the market to the next level. And that would also mean that they may want a lot of liquidity. So if we want a lot of liquidity and we need big positions in, it makes sense that if a market breaks to a new low, and that's a significant breakout that you can see on the left-hand side, that if it ever comes back to this level, there could be sellers there, wouldn't there?
Yeah. That's a classic sell zone too. Like, I mean, you've only got to look at it and see that, coming back to that zone, you have to imagine, like Tom said before, when someone is actually selling orders, someone is actually buying them. And that's really what's happening there. There are orders that are being held there at that zone. So it really is, although the market looks like it might be turning up, exactly right. So it took the words out of my mouth. It's a trap. And realistically, and the retail traders who don't understand what is potentially going on in the market, have a good understanding of what's actually happening, are the ones that are going to go looking for the long move from that point. They're going to see, potential breakout or starting to turn up, maybe a double bottom that's really not a double bottom at all, but they're going to start trading long. And of course, all that's doing is really facilitating where the big players of the market actually want the market to go. All you're doing is basically filling their pockets.
They buy who's selling.
Yeah.
Because remember, your buy is counteracted with the sell. So it's always a question you've got to ask yourself.
Yep.
Now, the key here is not just knowing like maybe a support resistance theory, but it's actually recognizing this. So as I mentioned before, the key that most people are going to have is something like this, a supply. But as I was talking about, actually, this is a Q&A from one of our courses, Ty. This was actually a level where I actually mentioned, this is going to be key. And funnily enough, in that Q&A, he had a question where he'd had this one as the supply, and then he'd instantly recognized this one was also a level of supply that he was going to trigger off. And he was absolutely correct in this case because it's a key level. Now, you'll notice the market sits around and it creates what we call a doji. Now, the thing about markets is they're actually fractal. Of course, we think about markets as times. And I think it's a bit of a mistake by most traders. Instead, we should be talking from a supply-demand standpoint as market structure. And in general, we should be talking about structure and positioning. Whether it's a 47-minute chart, a 1 hour, 25-minute chart, a 2 hour chart, a 5 hour chart, anything like that, we think of those because in our mind, we love the idea of round numbers, 60 minutes, 2 hours, 4 hours, etc. But the market doesn't care. It's based on where are the positions. So remember, what a long leg doji or a doji candle really is this underneath. It's the market being stuck within a zone where it has found effectively what we call equilibrium or neutrality in the market. A lot of people call it indecision in the market. So if you have indecision in the market and you see a doji, a good rule of thumb is that that would mean that underneath nothing really has happened. It's just sat there. Now, if it's sat there for a day, that means there's equal amount of buyers and sellers. When the market breaks to a next zone, especially if it's a significant one, what is that telling you about that particular level in this case? It's telling you that these were sellers and that it's most likely supply. So if the market comes back up into that level, you might initially think, okay, this is a sell. But the advanced traders are going to say, okay, I think it's a sell level. Remember, patience, react, don't predict. And instead, what they're going to do is they're going to be patient enough to wait for the market to show them whatever their trigger is on the smaller time frame, on the daily, or like, when I said the daily, more like the day time frame, like 5 minutes, 1 minute, 3 minutes, 15 minutes. They're going to look for the trigger. And in most trading, what everything is about is coming up from the higher time frames. We've always said this for 10 years, I think, Ty, maybe even 12 years for us personally. Not the first 2 years. I don't know if we did it. Actually, probably even more now because it's 2024, isn't it? So we're going to go with 14 years, actually. But realistically, I can tell you the first couple of years I traded and invested, I didn't do it this way. Instead, what I would do is I'd stick on the time frames that I was trading instead of looking at the picture up and down, instead of thinking about markets being fractal. So if you get a tip out of today, we really want you to get the tip of markets. And yes, you're deeming a certain time frame, Ty, but that doesn't mean that that should be what you're thinking about. You're thinking about positioning. Remember, it's the study of force. We know markets have gone in at a certain level. We know that a doji on whatever time frame like this means that market structure is sideways. We can then see that by going down to the smaller time frames, and we can recognize that that means that orders were placed here. And actually, this is going to be a sideways price action brings in more volume across that board, doesn't it, Ty? And means that price is more important than just a giant candle like this one.
Absolutely. That's far more important. And that's why understanding these zones is so important, because people get caught up in the big red candle, the big green candle, Tom, and they think, well, this is where the real money is. But that could be a very, very light volume candle, that big red candle there. Like, that could move extraordinarily quickly with hardly any orders going through it. In fact, there's a pretty good chance it probably was. That's generally what happens. But when you've got a consolidation zone where you're seeing a lot of candle structure inside a particular high and a low, that's volume. That's real supply and demand, and that's when you're really getting to the crux of what's actually happening in the market. It's not just one big candle. It's the zone that you really want to be looking at. Understanding the zone is the most important thing.
So what you can see here is, as Tyron mentioned before, this could be triggering buyers, and therefore they would take sellers. But notice it happens into this range, the area of supply. So you don't really want to make the prediction it's going to happen, but if you see the reaction in the way that you want to see it, whatever that be on the day trading time frame, then usually that would be a very good entry. And of course, if it's in the overall higher time frame direction, being the daily, the weekly, the 4 hour, that's going to be a lot better, isn't it, Ty? The trend is our friend in this case. Yeah,
absolutely.
So it's what we call a drop-based drop, actually.
Yes, and when you are trading in the bigger direction, that's why it's so important to do multi-time frame analysis, and that's why you can't be focused on only one time frame. But if you've got the bigger time frame in your favor, the chances of a successful trade in that trend's direction, when you see it set up like this, increase significantly.
Yep. So it's just come back to the base. That's where we already know something happened because it led to a big structural break. It's actually an excellent entry level and very good. Now, we've got one on the fly here, Ty, from Education. He's actually asked, what do we think of gold? Can we have a look at that? Sure. Let's have a look at gold from the standpoint of what's happened recently and also talk about supply and demand theory. So we'll do some analysis here of what we would have been looking at. So we've got, obviously, a weekly time frame up, and that's because predominantly we like to look at weeklies. We like to understand what's going on. You can see there were some big parameters that I've even got on this chart. And I've mostly wiped this chart because I've started many, many times fresh on it. But you can see here there was this previous trend line. Now, this is just an example of why you're going to want to look at higher timeframes. You notice it breaks this trend line here, which would be visible on a 2-day, a daily, a weekly, everything like that. And you'll notice that the market comes up to this level here, specifically into the closes here that are around this level of wicks. Now, this will be a bigger time frame supply. And of course, then it reacts to that and it comes back down to a 20 moving average, which is obviously mean reversion, a great moving average, Tyron's favorite. And you get a lot of movement around there. Now, recently, we've come back down into these wicks down here on the weekly. So let's take a look at this on a smaller time frame. We already know there's a weekly 20 moving average. There's previous resistances. So you've got that kind of role reversal. So you'd already be interested in this zone based on a weekly itself, if it came back down to it. Then you come and look at a daily, and I think there's clear signs that this would be an interesting level because you can see it reacted off those before. And I'm just making these, I'm not completely structuring them up correctly. But the reason why I'm doing that is because with supply demand, with any of these things, you're ultimately going to need a trigger. And actually, it doesn't matter too much how accurate exactly your supply demand theory is in terms of where you're looking for the positions. The most important area is that you trigger off these zones and you see the reaction. Now, they do have to still be relatively good, yeah, Ty, but it's not, you don't have to finesse it perfectly. Yes, I know how to do it, so does Ty. It takes a little bit longer to finesse it down perfectly, but you're looking for those basic structural zones where you're looking for wicks and you're looking for dojis and you're looking for areas on the smaller time frames where effectively the market's gone sideways and then broken in a certain way. If it breaks up, it's a demand zone. If it breaks down, it's a supply zone. So you're looking for a reaction back into that if it comes back and then bounces or sells off.
Absolutely. And this is why we always say that, especially for people who are first starting out, understanding that you are actually part of a prevailing trend is an enormous advantage to you because the market can be a lot more forgiving. You don't have to be as precise with your absolute entry points if you're trading in the general direction of where the force really is. So you don't have to be cute, I guess is the word, Tom, you probably want to be looking for there. The market is a lot more forgiving if you're trading with it. Okay. It's, it makes sense. I mean, obviously it probably sounds very obvious and you say, well, duh, but in reality, you can understand that, shallow pullbacks against a very, very strong prevailing trend are going to generally be short and not very long in their continuation. So if you don't enter precisely, you're going to get taken out on the other side. Whereas when you are in the direction of the trend, even if you missed it a little bit by the perfect entry, chances are the market forces are going to push it in your direction anyway. So it's a lot more forgiving.
Yes, it really is a lot more forgiving. Now, this is a great example because at the moment, what the market's done is you'll notice I have here the most traded zone. And that just means that we've done analysis. We've figured out that price is the most traded, most liked price. So therefore, price has touched it pretty much the most amount of times. You can kind of see that's exactly how it's occurred when you look at the structuring of the market. Now, what happens is if a market breaches through or a market breaks below, then it will often go to the next point where there's a decent amount of trades. And a supply demand theory person would obviously be looking at this, and so would a resistance-based trader would be looking at the structure up here. But where I think the resistance-based trader would be a little bit wrong is that on the left-hand side, again, you'll notice something similar to what we mentioned before, which was that we had that doji that led to a big breakdown. And what this is actually it's a little structural zone which led to quite a large shift in price. Then price came back up and it tested that zone and sold off, and it tested that zone and sold off. So actually what it was reacting to was over here. And I think a lot of people make a mistake of seeing what they now see and saying that's the level, and they often get stop loss hunted due to that. So what they'll be doing is they'll have a little stop loss above here. And of course, that may not be enough, especially if it was just, let's say this wick wasn't here, especially if it was just there in terms of where the stop loss was. It would often come back in and test the price because it's more based on the structure of over here. So this is the supply. It led to a big sell-off. You can see it's basically news related because there is a volume spike there, which usually means news. And at the moment, because the price is trading daily above the most traded zone, it's kind of trying to move towards 2060. Now, will it be successful? This is not the best setup I've ever seen, but it has closed above. So what's your opinion, Ty, when we close above in a zone like this from a technical perspective? We've actually gone above these wicks, haven't we? Above these low closes.
Yeah, it's doing its darndest to move up. There's no question about that. And look, with a lot of the world indices hitting all-time highs, it is certainly helping the gold story as well. And while the thing is, while it is trading above the 20 moving average, and while it is basically forming new highs above those wicks, which we know is a very important zone, you've really got to
Mhm.
trade that with a lot of trepidation if you think you're going to go short, because realistically, you are going against what is probably an interim, pretty strong trend actually on the way up. So
Yeah.
to me, it does look like it wants that 2060 price action. Looks like it wants to get there. But we really, that's the number that I'd be looking for. This is not a great short here. It's not a great setup, to be honest. I mean, I think we kind of isolated that. It's not the ideal setup. I don't like. There are things there that I don't really like that it's done.
Mhm.
But
Mhm.
if you were gonna put in a bias, I think I'd be biased to the 2060 before I'd be going to the 1980.
Yeah, look, there are some nice changes. Obviously, we've breached and we've come down to this level, which was interesting on a different time frame. Then we've breached up. We've found 2015 high, kind of low support, and you can see as you go through the lower time frames, you saw a little bit of pick up here. You saw a couple of spike downs, and then you saw some nice higher highs and higher lows, and that's really what's currently driving the market. It's coming through this 20, and you've got a higher high and higher low scenario. So I guess the grind to 2060 is the theory. Now, in this case, it's theory, and obviously we should be very careful with what you do. As Tyron mentioned, it's not really the best setup we've ever seen. It's just something that is there. Now, there are some other kind of levels. So let's have a look here at US oil as an example. So you'll notice that US oil has come back to a level that I've got boxed. Now, why would I have this level boxed? Because basically, if you think about it, this area in here has predominantly been the top of kind of a supply that led to a very fierce sell-off that went all the way into probably an overly extended market. Now, Tyron and I talk a lot about the 20 moving average, specifically the weekly and the daily ones. And you'll notice that what the market was doing, especially on the weekly here, notice the movements. It went wick up, long leg doji here, by the way. Then we had another doji. Then we had a shooting star, which is this type of rejection candle. And there were a lot of wicks that came off this zone, and it kept giving us negative weeklies. Then suddenly we get that bullish hammer and we start to build a position. And then we breach straight back up. So basically what's happened is this is an equilibrium level of great demand. That's a fantastic demand, fantastic support area. Once you start seeing reactions off that, you're probably a bit more smiley face about it. You'd firstly want to be thinking about TP zones for sure on the smaller time frames. And you'd also want to be thinking about the reverse. But what you'll notice is that when it does reverse, it comes back to mean reversion, and it also comes back to these wick highs, because something happened when the market kept coming up here, and you can see with those wicks, it kept failing there. So if it's failing there, Wyckoff said it's the study of force. We have to think the composite man, which Wyckoff claimed was the whole market basically against us, is thinking about placing shorts there, and they have been placing shorts there, because each time it tried to rally tie, it got pressed down. And that's a very big clue, but you're only going to get that if you go to a higher time frame. And again, as a scalper or day trader, this is where you're going to get your edge. And then you're going to need to drive that into the smaller time frames. So let's say you thought, okay, this is a good take profit zone. Then you're going to need to drive in and say, well, it might be a good take profit zone. I'm going to now look for opportunities, if it does come up to this area, of potential shorts. And you can see initially it did short off that zone. So possibly there was a trigger in here that you may have been able to use. And you can see it's hovering around this area because it went up really quickly. So yeah, there are, like, even right here, I could see a case for this to be, a possible short zone tie from a technical perspective, because markets did rally up. They'll make a series of higher highs and higher lows. And then all of a sudden something changed and then it rallied up. So, this is a very pivotal point for oil. Oil will either find a buyer somewhere around here, you would think, and then try to find a new buy high, or oil will fail here. And if it makes a new low, that's not exactly going to be fantastic for the oil trade, is it?
No. If it makes a new low, you're really starting to target that sort of 72, 73 area again. It's caught. You're right. It's certainly looking like it wants to react. But I think understanding the zones is also understanding the time frames that you can actually trade successfully as well. Like when we switch between charts, like 5 minute, 15 minute, or 1 hour, or whatever it is it's going to be, you've got to make sure that you're actually able to actually trade that time frame successfully. Don't just do it because you're trying to find the exact situation that you want to create. You need to be, if you're a scalper, you need to be scalping Not just setting and forgetting on a 5-minute chart, right? So it's very, very important to use the time frame that actually suits your style of trading. You need to make trading suit your style, not your style suit what the market is doing. It's very, very important, and you got to look at it from almost a selfish standpoint, Tom. You need the market to work, with you, yes, obviously, and you got to work with the market, but it's got to be, on your terms. Okay, it's very, very important that it's on your terms, because if you don't, you're not going to be able to actually manage it and basically look after the trades as you should. Because of it, it's very, very important, and it might seem insignificant, but if you're trading the wrong time frame for your particular style or for the time that you've actually got to trade, it's going to bring you undone very, very quickly.
Yeah, and I think if it's going to bring you undone, then it's just not worth doing. And that's you have to think about just being, having your rules. I'm going to quote, Ty. I'm going to quote. Okay,
I've got a quote too.
Go. Okay, you go your quote. I've got mine up.
This is a quote. Actually, this is a quote from Tyrone himself. And my quote is, choosing not to trade because a setup is not there is a trading strategy in itself. And that's my quote.
Okay. Yeah.
Because it is. Choosing not to trade because it's not a setup is not quite right is a trading strategy.
Yep. So in trading and investing, it's not about how much money you make, but rather how much money you don't lose. There you go. You can go with your one. But actually, I was going to use this quote, which is obviously when you're talking about anything to do with trades, really, I think the four most dangerous words in investing and trading are this time is different. And that is that. So that was actually Sir John Templeton. And the reason we say that is because when you think about it, you're going to say a lot of times in trading, you're going to say, oh, I feel it. I feel it. Now, that's a bad word. I don't know. Maybe I should put a quote out there. If you feel it, don't do it. Anyone ever had that in the comment section? I'll put my hand up. Yeah, I felt a couple of trades. And the worst thing that can ever happen to you in trading is when you feel it and then it works, because that's obviously feeling into that gambler's fallacy. We don't want that. So what we want to do is we want to be cool, calm, collected, have a structure, and obviously follow those rules. And we go back to that quote from Warren Buffett. So in this case, you have a pretty good looking supply. You obviously know this is a critical zone. And if it breaches this critical zone, where do we go? Well, the reason I've left this on the charts is because then you can start to look at the left-hand side. The beautiful thing about supply and demand theory is that you're looking to the left-hand side for evidence of where there might be more reactions. And of course, it looks like there was a sell that went underneath this key level here, and it sat underneath there and it kept testing it. So most likely it's actually up here around that 84 that you're looking for supply. So just remember, when you're looking at the left-hand side, think about the dynamics. Think about what happened. Did this become the big sell? Absolutely. Is there a chance that there's something in here? Certainly could be a little slither of a zone that you could look for, take profit or break evens. And then the next zone is going to be somewhere around probably that 84. And there are a few other learning lessons that we've talked about, including volume profile work on this channel. Again, look at the backlog that we've got to try to understand that a little bit better and understand where the positions are. Because my belief, Ty, is that over the next couple of years specifically, we're going to need to move more to position-based trading, which has already been a lot of what the market's been doing for the last 5, I would say, to 7 years. And it's always been that way, but I think it's really relying on you understanding where the orders are. And you've got the tools nowadays with Pepperstone and TradingView and everything else.
I think it's imperative now, Tom, moving forward, that don't forget, if you've got the tools, so has everybody else. So if you don't use those tools to your advantage, you are going to be behind the 8 ball in a very, very big way. And I do agree. I think if for people who don't understand what the market zones are that we're talking about here are, I think you really need to school yourself. There's a library of videos that we can't even count that we've done on the Pepperstone YouTube channel, where you can basically go to every single topic there is out there, Tom, and we've done a video on it. So we really, really encourage you to learn as much as you can, because moving forward, trading isn't going to be the way it used to be. I think that you really have to be fairly strategic in how you're going to trade moving forward, because there's no room for let's just hope it goes longer, let's hope it goes short, or I have a feeling. anymore. I think the market's too in tune now, and traders are a lot more savvy. You're right. The tools that Pepperstone make available to us through the TradingView platform are incredible compared to what we were used to when we first started. The tools are just incredible. And if you don't use them, rest assured someone else is. And that's the very person that is effectively potentially taking your profits away. So it's extraordinarily important to really give yourself the best opportunity by actually learning the methods and understanding what you're seeing. If you understand the market, whether you're actually buying or selling, you're so much closer to your end goal of actually making money on the majority of your trades. It's really, really important. We can't emphasize it enough, especially moving forward.
I'm moving over here, the dollar index. And again, I want to understand that probably the supply actually begins here because, of course, we have the drop and then we have a reaction to this that leads into that big drop. But this is therefore a very important point. And you're between here and here really is where the action lies. And again, look to the left-hand side and you can see that's why we're kind of looking at this area. Now, this is a big week. So we not only have the FOMC at the time of recording here, but we also have, of course, the interest rate decision, the FOMC conference. And then we have non-farm payrolls, and we've got Apple earnings and all sorts of things going on in the markets. It's massive. It's pretty much the biggest week of news that you could ever see because it's a stack of tech stocks at a critical period, with central bank at a critical period, with obviously unemployment also as a question mark at a critical period. So lots and lots of moves. But what you'll often see is the market is coming into a zone potentially where it may see a reaction. Now, do you know that's going to happen right now? No, we can't really predict it, but we are looking. It's like playing chess instead of checkers. So that's what you're going to start to want to look for. So tip number 2 or 3 for today would be when you're setting up, especially for news, at least the way we've looked at it is better to actually see how news plays out. And sometimes it's better even not to read the news because you'll often find that it will often do the opposite of what you think is logical. And that's because it will have priced in moves that you can't contemplate and can't understand. And instead, what you should be looking for is areas of technical hits. So if it hits this zone and then does what you would consider a reversal, then that could be a very interesting opportunity. Now, of course, you need your trigger systems and everything, but I find that it's better to react after the news and to see what we call liquidity grabs. So that's something that maybe you can have a look through some of the history of the videos that we've done, and I hope that helps. If you enjoyed today's video as well, Ty, I just guess I want to say, make sure you give it a thumbs up, and also links in the description down below where you can sign up for our webinar series. Remember, we're going to move more into this type of analysis where we're going to be looking at, maybe more live market analysis and doing, the technicals on that using a varying range of different techniques. And I think that's going to be really exciting for people to go back over and see how you top-down analyze markets all the way down into the 1-minute charts. Ansi Tune says, damn, it's so true. I should have heard that yesterday. It's just a learning experience, Ansi. Unfortunately, sometimes that happens. But once you remember, harness what happened yesterday, which is obviously doesn't sound like it's good because you've got a crying face, but still harness what that felt like. And then hopefully you can learn off it because we've all been there.
I've been there as well. Absolutely. Of course. Yeah. Everyone has. Yeah. I think the important thing there is to make sure you've learned from it. And the best lessons learned are the ones that actually cause pain, Tom. You're not going to learn a lot of lessons by winning every trade that you do. The ones that will cost you money, the ones that you're going to learn the most from, but they are the most valuable lessons a lot of the time because they're the ones that you will remember. And the most important thing is it's not a bad thing to make mistakes. It's a bad thing to make the same mistakes when you've done them over and over again. Remember that. And if you do that, you're always going to put yourself in a position where you're going to learn and evolve with the market. This market is it's fun and games, but it's not it's evolving as other traders. So you really need to evolve with it. And the more you understand and the more you appreciate it, the better it's going to be for you. There's no question about that. Do not make the same mistakes over and over again.
Well, we're going to leave everyone with a quote here today, Ty. Insanity is doing the same thing over and over again and expecting different results. Albert Einstein. There we go. We've got a good quote. That is absolutely. We don't want to be doing the same mistakes again.
No.
And of course, Albert Einstein, he's a pretty smart guy. All right. Well, thank you very much for joining us. Links in the description down below of how to sign up. Obviously, for our weekly events. Next week, we come at you with live market analysis. So we can go through a whole bunch of different things, including indices, Forex, commodities, stock, all the things that Pepperstone offers. So it's going to be sweet. And I think what you'll find as well, if you only trade one pair or something, is you'll find that the techniques, especially good techniques, can often go over multiple different pairs and instruments. Tyron and I are really excited to do it, and we hope you are as well. Thank you so much, Tyron. Any last passing words to finish up?
No, we are really, really excited about what's coming to you guys. We're very excited about bringing it to you. And I do believe that we may even take the occasional stock check or currency check from the room. So I think we might even be doing a little bit of live analysis where people can jump in and actually say, can you do this or can you do that? We can't do every single one, of course, because we expect that there's going to be a lot, but we're going to do the most popular ones, and you're going to have a chance to be interactive with us. So we are very, very excited about that.
It's going to be awesome. All right. Thank you so much from us and obviously for Pepperstone. And we'll